Hi, everybody. I'm Barry Ritholtz, and this is not Masters in Business. This is a special panel discussion on what's going on in the world with two of the most esteemed investors I know of. Felix Zulauf, I can't really introduce a man who needs no introduction, other than to say he's one of the most highly regarded macro investors in the world with a track record to prove it, not just a theoretician, but somebody who actually invests his own money. Look no further than the Japan bubble in '89, the bull market in the US in '82, and multiple prescient calls on gold and the economy. Not just theory, but expressing those beliefs in actual capital. Joel Greenblatt comes at the markets from a completely different perspective. He's a bottom-up stock picker and effectively a value-oriented quant. I think that's a fair way to describe it. His earlier hedge fund, Gotham Capital, put up spectacular numbers for a decade, about 40% compounded annually. I'll let Joel caveat those with all the usual SEC disclosures. He is also an adjunct professor at the Columbia Business School. Felix is currently running Zulauf Consulting, which is a research and consulting firm. Joel's new firm, Gotham, it's not Gotham Capital, it's Gotham Investing, is that right?
Gotham Asset Management.
Gotham Asset Management runs a variety of different ETFs and funds and has put up some pretty healthy numbers over the past couple of years. So welcome everybody to this. I'm going to try and save some time at the end for any audience questions. I have a bunch of questions myself, and I want to start with one that involves the current state of markets and media. Felix, you were a member of the Barron's Roundtable for, what was it, 30 years before you retired? Joel's written 4 books, 5 books, I've lost count. So both of you understand how media and narrative can move markets, but what do you make of this current environment? Social media, meme stocks, Reddits, how are we to contextualize this? Why don't we start with Felix top down, and then we'll go to Joel bottom up.
Well, I think the cycle has been here before and it's here again, and it's just the noise around the cycle and the speed at which news travels is much faster. So I think it's the speed of the news that is faster. It is a broadening participation due to social media, and we have seen particularly over the last 12 months in the US. But other than that, everything is the same, except that the authorities have gone beyond certain limits that we have never seen before. But it is the classic cycle. We always see a few things that are different and more excessive than in previous cycles. That's normal. So I do not approach this as a new era or whatever. I think it's a normal cycle. And it shows all the classic signs of a cycle early in the beginning when nobody trusted it, and now that many are believing it, and we will see, and we are seeing some of the excesses that you usually see at the top with speculation, etc. It's all there, and it will probably grow somewhat bigger before the cycle is over.
Joel, what are your thoughts on this? Looking at stocks from a bottom-up perspective, what do the Redditors do to equity markets?
Yeah, well, I don't think they're huge, but I think they're telltale signs of extra speculation. I think in the internet bubble, if you looked at all the accounts for E-Trade, I was talking to one of the CEOs many years back about what happened to those traders in the internet bubble, and about 90% lost money, and I would expect the same thing to happen again. It's a sign that things are frothy. I don't think the size of, the names, whether it's the AMC or the GameStops or whatever, are, they're in the billions, but they're not, driving the market. But they are a telltale sign that things are frothy. And so, I think in 29 it was the shoe shine guys asking, talking stocks. And so, the more things change, the more things stay the same, that it's a telltale sign that things are a bit frothy. How much longer it has to go, couldn't really tell you. As everyone knows, I think valuations are extended in general. There are better places, there are not. It's always, particularly with the stock market of stocks, not necessarily stock market as far as we look at it. So there are opportunities, but in general, things are extended overall, and that's just a telltale sign.
So I've discussed this issue with people, and there's definitely a generational divide. And some of the younger Robinhood traders say, listen, we're stuck at home, we're bored, we have nothing else to do. It's not like we're going to Knicks games or we're going out to concerts or bars or restaurants. There's only so much Netflix anyone can watch. Day trading is our entertainment. What's the response to that?
Well, I would recommend that they look at it as investing and not as entertaining, because entertaining could become very expensive entertainment over time. Many of those who have joined and entered the market as newcomers over the last 12 months, and the numbers show that the broadening of the participation is huge, from about 25% of the US population to more than 1/3. So we are approaching 40% or so, or no, even 50%. That means that they are going to make to learn a lesson, because markets go up and down, and we are still in the up part of the cycle, and there will be a down part of the cycle. And when that down part comes, as Joel said, they will lose 90% of what they made before, and even more. And that's coming. So I would recommend them to read some books about business cycle, financial market cycle, speculation, to learn about it, and try to limit their losses once the market turns down.
All right, I'm just writing this down. Markets go up and down. I think some people are going to be genuinely surprised to hear that. So Felix mentioned books. Joel, you and I were talking earlier about Adam Smith's Money Game and the story that's told in there about fund managers hiring young people because they haven't experienced the downturn. Are we seeing parallels there? What's the advantage of hiring untested bulls?
Yeah, I mean, there really is no advantage to hiring untested bulls, I would say, except in this environment over the short term. It's been a good thing to do, and it's always the case before things fall apart. I would just say knowledge is good, to quote Animal House, and most investors now don't understand that what stocks are ownership shares of businesses that you have to value and buy at a discount. The vast majority of these people, and by that I mean over 99%, have no idea how to value a business. And so these are people, I gave a talk at Google about 4 years ago now, where I started that even Warren Buffett thinks most people should just index. And I said, I agree with him. I also said Warren Buffett doesn't index, and neither do I. How come? So there's different ways to skin a cat. But for most people who don't understand how to value businesses, they have no business investing in individual stocks, especially they're going to be buying the ones on Reddit. If they understand it's a game and they don't bet a lot, I have no problem with it. That's not generally the people who get hurt. The people who get hurt are the people who, have some success not knowing what they're doing and gamble more than they can afford. And Ben Graham said they're investors and speculators, and these are clearly speculators, and it's not a good long-term strategy.
So Felix mentioned 1990s as a somewhat parallel. I'm a big fan of trying to compare different historical periods. What other past periods might be parallel to today, not just in terms of financial speculation, but where we are in the economic cycle, what's happening with the Fed, inflation, interest rate? What do you guys see as, well, nothing may be precisely identical to this, but there are some parallels that might be instructive in history?
Well, we are probably at the end of a secular disinflationary period, and authorities and central banks are applying new policies that because the ones they used before did not work out as planned, and therefore we are now in a new era in that sense that they think fiscal deficits do not matter, and it's all going to be financed by central bank money creation, etc. And that will have at some point a very rude awakening. So I think this is a change from the previous 30 years or so, or 40 years or so, that we are trying something that has been tried before, but was very bad in the 1970s and was then straightened out by Volcker and other central bankers around the world. And then we enjoyed the downturn in interest rates, inflation for 40 years. And now we are trying to create inflation like mad. And you know, be careful what you wish for. Once inflation comes back in earnest, it's very unpleasant for the average person, and it's very unpleasant for the system. And therefore, I think it's in that sense a new era, and it will lead to something very similar to what we saw in the first half of the 1970s, I believe. I think we will see in the next 3-4 years a balance of payment crisis for the US. Because the external deficits will matter. And then we have a dollar crisis and the dollar decline, brutal one. And that will feed back into the bond market very badly with rising bond yields. And that will affect the stock market, and stock prices will then come down. So there is nothing new on the planet. I think the stupidity of policymakers is just unbelievable in what they are trying to do these days. And this does not just go for the US, it's the same in Europe. You know, the Europeans have introduced negative interest rates and stupid things like that. And it's the same thing. In contrast to all that, I see China, who in my view is the best educated, understandable of business cycles and economics, and is pursuing economic policies that are much more capitalist, whereas the Western world is applying socialism. And therefore, I think the Chinese expect a difficult time ahead, and they are preparing for it. They are slowing down their economy. They are restructuring. They are forcing the corporate sector through deleveraging and restructuring. And they are preparing themselves for the rainy day, because in the rainy day, there are huge opportunities around, and you can only benefit of those opportunities if you have prepared for it. And I think the Chinese are doing that. They are moving in that direction, whereas the Western world is just trying something new, worse than muddling through, and it will all backfire very badly.
Quite interesting. So on a related point to the deficits and monetary policy, over that same 30-year period that we're discussing that's been disinflationary, there's been a huge rise in both income and wealth inequality. Joel's last book, Common Sense, The Investor's Guide to Equality, Opportunity, and Growth, took a capitalistic way to look at how to bridge that gap. And I know Felix has talked about this from a macro perspective. So this raises the question, or two questions: what should be done to bridge that gap between the haves and have-nots? And what do you guys think will actually happen versus what should be done? Let me start with Joel.
Well, that's a great question. So, you know, I wrote a book with some observations, and you know, one of the main focuses was on education. If we're talking about inequality and how unequal education is in the United States, and that if you don't have resources, you get a bad school, meaning you can't move to a place with a good school. So automatically, good schools go to people with means, and bad schools automatically, people without means go to those. Very unequal. I do see an opportunity, though, going forward, that if we get rid of a credentialing like a college degree and just set standards, if businesses set standards of what do you have to know either through tests or courses to get a high-paying job, I think the internet and the proliferation of information is really hopeful in that area. And, what has been shown by bringing good schools to bad neighborhoods is that almost everyone can learn at a high level. So I think we have those human resources. And so the good news is, I think eventually, after exploring all the other choices, we'll do the right thing, and companies will actually be able to take a lead because they need good employees. I also think the United States is in a unique situation with regard to immigration, that so many skilled people want to come here, that if we got smart and opened up skilled immigration, we could turn around the demographic trends that are, happening in every developed country where we're not reproducing and, we're slowing growth. I think the next best choice where people would want to go is Germany, and we get 7 times more people who want to come here, skilled immigrants. So I think, as opposed to a brain drain, I think we could be a brain magnet in the United States. So we have with that advantage, we speak English, we have an open economy. I'm not too, it's not that I'm not worried about China, it's that, we still do produce somewhere around 5 or 6 times more per person than everyone in China. So they have a long way to go. GDP per person is about 5 or 6 times higher. They will have a brain drain if anyone can get out of there, because they're not a free country. And I think we have that going for us. And so I'm not that, and as far as the dollar is concerned, I'm not an expert. I would just say, as Felix mentioned, everybody, dollar crisis versus who, everyone else is degrading their currencies as well, or at least many of them are. So I'm not super negative in that regard. If you go back in history, you can see that, in the internet bubble, growth stocks beat value. Growth meaning, hope for the future, beat value by 10% a year for the 5 years before the top of the internet bubble. And we've been identical, approximately 10% a year. Growth has beaten value, even with this latest rally in value. And the value rally lasted, 4 or 5 years. I think the difference this time, and agreeing with Felix to some degree, is that the value stocks were very cheap, even though internet stocks were super expensive back in the internet bubble. The value stocks were super cheap, and I think right now everything's expensive. Value is a relative bargain in the stock market, and so I don't think we're as well situated to take on some of these negative trends that may happen as a result of Fed policy. And I do think we'll have to, regardless of what happens in inflation, I'm pretty sure after World War II, which, fighting COVID and spending a lot of money that, all at once, to the extent that some of that ends, if you keep increasing entitlements, that's different than spending money and then stop spending that money at that rate. And some of that will happen here. I do think that, we will have a chance to rebound a little bit from, where we were in COVID. So we have that going for us too.
Interesting. So here's the market question that relates to this. The argument has been monetary policy tends to favor capital in all its forms, real estate, equities, etc. Fiscal policy tends to favor labor. Are we seeing a pendulum swing from monetary driven very capital favorable policies towards a more populist fiscal policy that tends to stimulate the economy and benefit workers? Or am I just wildly oversimplifying this? Let's start with Felix.
But first, back to the other question that I haven't answered yet. You know, what you have to do to fix this problem is, first of all, you have to give every kid in the country a great education. That means you have to make public schools great. That's the starting point. And then you pursue sound economic policies. And of course, the society must be open, that everybody that is born at the bottom can move up to the top. I think that is possible in the US, except that many people in the US cannot afford the top schools. The top schools are for those who can afford them. So I think those are the preconditions. And then sound economic policies is, over a business cycle, you have to have a balanced budget. A balanced fiscal budget. That is an absolute necessity. Otherwise, you run into the debt spiral sooner or later. And then you have to have sound money and leave the interest rate setting to the markets and not to a bunch of people sitting in a room and deciding what the right rate for the stock for the economy is. You know, if you apply those sound policies over time, I think the problems will be reduced that we are having and facing, and it will be a much more pleasant environment. So, and then labor swinging back. I do believe that the separation of the Western society in the haves and the have-nots is a very dangerous situation. And I do believe that there is a social backlash and it leads to socialism. And I think society or the corporate sector has to pay people more. And therefore, I believe that the price for labor will go up. And as actually demographics is also playing in that hand. That means that when you look at the share of profits and the share of employees that they take home at the end of the day out of the economy, I think we have gone through a very long downtrend for labor, and that is bottoming, and I think it will move up. That means that profits as a percentage of national income will most likely decline from a high level, will most likely decline, and labor will go up. If we don't do that, we will face a revolution, a social revolution that could be very serious.
It looked like we saw some of that during the previous administration, and certainly January 6th was unprecedented, at least in my lifetime. Joel, what are your thoughts on the balance between capital and labor? Is the pendulum swinging back? You just had to be front of mind when you were writing your book on the Investor's Guide to Equality.
Sure. Well, you know, what I suggested in that book was to greatly expand the earned income tax credit. Right now, to pay people not to work doesn't make sense. To set, to some extent, to tell businesses to pay $15 or $20 an hour to people who only are contributing $8 an hour worth of benefits doesn't work in a capitalist system. But an earned income tax credit where everyone can at least earn $15 or $20, or you pick your number, where the government is supplementing that, I think is a very important program. And when you look at the costs of childhood poverty in the United States, you know, a number of studies show it's about $1 trillion a year. So actually you can make money by, you know, making sure, you know, by eradicating long term, you can, and that's $1 trillion a year. So we can eradicate, if we can eradicate childhood poverty. Felix mentioned education. Our problem in the United States is that we have a Soviet-style education system. They've doubled spending over the last 50 years with no improvement in returns. There's no incentives within the system for good performance. And so what I suggested in the book was that lower income kids are just as capable and just as smart and with the right supports can do just as well as the wealthiest students. And so what can you do about that? And, I suggest an end run around the system, and I think we'll get there. In other words, businesses will start needing qualified people, and there'll be alternate certifications. There'll be alternate ways to show your stuff. The current system where you have to tick off a bunch of boxes along the way, that's a long-term project, and of course I'm for that. I just don't think that's a short-term answer, but I do see a short-term answer in businesses saying, hey, if you have these skills, you pass these tests, you did well in these courses, that we will specify, we will set standards. And then a whole ecosystem, once you have a buyer, a whole ecosystem sets up to get people to pass those courses or tests, and all the prerequisites that you would need to pass those, I think can develop organically. As long as there's a buyer at the end, that's how capitalism works. And I think capitalism can actually save, typically government's job of providing a good education. I'm not saying government shouldn't keep trying, but we spend $1 trillion a year. We're not doing a very good job. It's not going to be a very fast. It's very tough to disrupt a $1 trillion a year bureaucracy. And so that's what I suggest in the book. And I'm actually pretty optimistic that we'll get there sooner rather than later because we need to. I also think, when I was talking about immigration before, skilled immigration, it's not a zero-sum game. I mean, our immigrants in the United States, are responsible for almost half the billion-dollar-plus businesses that get formed. If you go through the statistics, they're 2 or 3 times more likely to start businesses, create value, and they actually are big pluses, and they can also bring up employment here for the people with less skills. So I'm actually pretty optimistic that we'll eventually get there. It needs to be faster than it will be, and I am worried of what Felix is mentioning about the creeping socialism. It is an unfair system, or at least the outcomes are unfair in many cases, and there's a backlash to that. And unless we get our act together, it'll be a continuing problem. I like the fact that we have a quote-unquote labor shortage, and people are going to have to be trained to take those jobs, and I think that's those are some encouraging signs that maybe we won't be there. I also think that as opposed to Europe, we have a different, most of the people who came here are immigrants, whether it's this generation or the generation before that. And it takes a lot. I mean, if you really look at the makeup, and they've studied that, people who leave their homes, either forced out or decide to leave, are made up a little differently. And I still think we have a lot of that in the United States, and I'm encouraged by that as well. I think
So for people who may not have read Joel's book, I want to point out there were a variety of fascinating takeaways, but the discussion on charter schools as magnets in low-income areas, and the discussion on business certification where, hey, you don't need a doctorate or a master's degree. You check these boxes and we'll hire you is really fascinating. And anybody interested in learning more about that should check out that book. Let me shift the conversation a little bit back to the dollar and to a broader conversation, which is the narrative behind crypto seems to be the dollar is being destroyed. It's no longer going to be the reserve currency. Printer goes burr is a meme everywhere. So a couple of questions about crypto. The first is, do either of you guys own any? Do you think this is a new form of currency, or is it a speculative bubble, or all the above?
I wonder how Joel would value a Bitcoin. I do not own any. My son, I should have listened to my son. He was in it early, and he's still in it. I do not own any, but I sent out a short memo. The last one was April 19th, when Bitcoin in the morning, when Bitcoin was trading still slightly below 60,000, and I said, you will see a correction now, going down to first the low 40,000 and then the low 30,000, and we were there in less than 4 weeks, I believe. We were there. So I also said in one of my recent reports, I think it was 2 weeks ago, that the 30,000 will stand for quite some time, and we will see rally attempts of those highs. The Bitcoin and the cryptocurrencies are really a result of the declining faith in our central banks. And the libertarians see what's happening to a fiat currency system, because eventually all the currencies go bust and disappear and get replaced, and you get confiscated if you are a saver in that currency in a way. And therefore, they wanted to have something that was limited. I understand all that. I think Bitcoin is not the ultimate store of value, but it is the dominating digital item to store value at the present time. I do not believe we have seen the highs yet. I think we will go higher. I compare it often to previous bubbles, like the one in the 17th century in Amsterdam, when we have tulip bulbs. And at the peak, one tulip bulb was valued at the price of a townhouse. So that's why I said a Bitcoin can easily go to $1 million. But today, tulip bulbs trade at $5 a dozen or something like that. So they come and go, and you have to be very careful, because I do not see the intrinsic value in that. As long as people believe in it, and more people believe in it, it goes up. Once everybody owns them and owns more than enough, I think the cycle will turn. So I'm not a believer in Bitcoin. I do believe that central banks and governments will actually declare them illegal at some point of time. You see it already that China has done that. Right. All the countries that are at risk of capital flowing out for whatever reason will declare it illegal. You have seen it in Turkey, and I think we have seen it in another country. So I think Bitcoin was an easy way to move capital from one place to the other where capital flow was not allowed. You know, China still has currency controls, and you cannot move 1/3 of your capital out of China without the okay by the government. And therefore they did it via Bitcoin. And I think that was a major point. I believe that central banks and governments will declare them illegal at some point, and therefore they will lose their value. But I cannot tell you when that is. So I'm not a fan of Bitcoins. I think it is classic that it has come to this huge rally in a period when there was plenty of excess liquidity in the system. And every market cycle has its own fad and a major fad, and I think the cryptos are one of them. At the beginning it was one cryptocurrency. Right now there are over 6,000, and therefore there is no limit to it. And when there is no limit to it, it is not unlimited, as they say.
Right. You know, I'm intrigued by the concept of countries making it illegal. There was a couple of articles recently that talked about what's the use case for Bitcoin other than payments and ransomware. So that's worth thinking about. Joe, what are your thoughts on crypto? Obviously, there's no forward discounted cash flow. Has do you look at these other than speculation?
I mean, that's really my answer. I can value something that either earns money or has the potential to earn money, a return over time. Something like gold or something like art is what someone will pay you for it. You know, Warren Buffett and Charlie Munger have a too hard pile. I would throw Bitcoin on the too hard pile because I have to read what other people are willing to pay for. You know, it's the greater fool theory to some degree. Right. And so I don't really have, you know, I have other ways that I know how to invest that I have confidence in. So I'm not going to disparage anyone who's made a fortune trading Bitcoin. I will just say not for me. I think I think it's a speculation by definition. There's no way to value it realistically. I think the fact that it's used for ransom, I can't believe that it's even legal to pay ransom in Bitcoin. I think they should just outlaw that right now.
And that becomes the end of that. Yeah.
Forget about outlawing Bitcoin. Just outlaw paying ransom in Bitcoin for the people paying it. And then you could stop that, not just Bitcoin, any of the cryptos. And, you know, that doesn't mean I don't think the blockchain has huge uses and will be, you know, hugely influential in the way we do business and the way we transact business. But that has nothing to do with whether I think Bitcoin's worth anything. And I don't know. And I'll find, you know, I like to find things I can value. And that's the only way I know how to, quote unquote, invest.
There's a current meme on both Instagram and TikTok about crypto traders cashing in a little bit and buying Lamborghinis. Who knew that was a prudent financial decision? I wouldn't have guessed that, but that may end up being one. So let's shift gears and talk a little bit about taxes. There's not only the expectation that corporate tax rates are going to go up in the U.S., the current administration is looking to get the G7 involved and have everybody set a certain floor to avoid forum shopping for the most attractive tax rate. What are your thoughts on this? What does the increase in the corporate tax rate do to valuations of equities, and what might it do to the bond market? Felix?
Well, U.S. corporate tax rates are slightly higher than corporate tax rates in countries like Germany. Right now they are lower, but as Biden administration hikes tax rates for corporations, they will be slightly higher. When you look at corporate tax revenues as a percentage of GDP, the US is very low on the list, with only about 1% tax revenues of GDP from corporations, whereas most of the European countries are in the 3% range. And I think it has to do with the too many loopholes there are in the US tax code. And the loopholes are there because of all the lobbying and all the payments that the money that flows between corrupt politicians and their special interest groups who have to finance campaigns and things like that. So I think instead of forcing the world to adopt higher corporate tax rates, which is a socialist step and not the capitalist step, because you remove competition in a way. I would encourage the US to first address the loopholes at home and then talk to other countries to raise corporate taxes. I think this is one of the many misguided elements of the Biden economic policy plan. You know, I'm very unhappy about it. And we have in Switzerland, where I live and pay my taxes, we have tremendous tax competition. Actually, the main tax authority is with the state here and not with the federal government. The federal government takes 8%, and then it is the state. And we have tax rates that differ by 100% or even more between certain cities and certain states in the same country, and you have tax competition. And due to the tax competition, our tax rates in general are relatively low compared to all the others. If you remove the competition, the politicians over time will pocket whatever they can. Therefore, I think it's completely the wrong way to go. And I fear, of course, that the socialists will win this battle and will raise corporate tax rates. And it will not be very good for the world economy. When you look at the historic outcome of tax rate movements, you do not see much changes in corporate profits, etc., etc. But I think there is a difference. We have now the most levered world economy ever. And if you raise tax rates in this most levered world economy ever, I think it does make a difference. It will force profits lower than they would otherwise be. And particularly if you start to close loopholes, this will definitely be the case. And you know, lower profits eventually means that you should have lower valuation. When you have lower growth, you should have lower valuations than it would be otherwise. So I think the Biden administration again is playing with fire here, and I do not like what they are doing. But we have to live with whatever the outcome is, of course.
Joel, your thoughts on taxes, where they are and where they might be going?
Yeah, so, you know, for the corporate tax rate, you know, to mirror Felix a little bit, it's only 7% of our, I'm not talking GDP, I'm just talking about our budget, our annual budget. We only collect 7% of the taxes are from corporations. So if you raise them 10%, you know, let's say they go to 25% from where they are now, you know, which is where the compromise is generally considered to be, that'll raise 0.7%. We're spending 20, or he's proposing spending 20, 30, 40 times that. So really it's just a political discussion. We're not going to raise any money from it. The real money is in trying to figure out how to, you know, like when Amazon, or let's just pick a name like Salesforce,
Apple,
which has software, okay?
Sure.
So basically, what they do is, because their customers are so sticky and the lifetime value is so good, if they can get a customer that's going to last 8 years, you know, and let's pay them $100 a year, that's $800. If they spend $200 this year to get that customer, it looks like, well, they're going to get $100 this year, and they spent $200 to get that customer, so they lost $100. So they're not paying tax on that. But that customer lasts for another 7 years. There's no contract, but basically it's very sticky. And so there's a whole accounting convention in which it makes sense for them to take every dollar they earn and spend it to grow. And Amazon does the same thing with all their new offerings and everything else. So, you know, we got to figure out how to collect money from those guys, because they have such great expansion possibilities without a contract. That means you just get to expense it. Right now, all that expense is for customer acquisition. You can think about it, and you can spend all your money. And as long as those customers are worth a lot of money going forward, or the services you're providing are worth a lot going forward, you don't have to pay taxes on that. So I think the biggest companies, the most successful companies, those top 5 or 10 names, no matter what you do with the tax rate, aren't really going to pay a lot on relative to their revenues, or, you know, how much economic value they're actually creating. And so I think that's another side problem. But I think the whole corporate discussion, because it's so de minimis, you know, however much they raise relative to what we spend each year on our budget, it just becomes a political discussion. And I think the same thing to do with capital gains taxes. I think everyone knows if you know, every time you raise them, you don't raise any, you know, beyond just a little bit from here. I think the Congressional Budget Office says beyond 28% for capital gains, you start losing money by raising the rate. People stop selling stuff. I think that's also a political discussion. So I think we're going the wrong direction, as Felix suggested, you know, in both those areas. I think it's a political discussion, and I think that's very real, though, that, you know, these sort of more socialist, not agenda, but just socialist leaning to sounding good rather than doing good is unfortunately the way things are going, and the most politically expedient thing to do right now. And so, you know, I'm worried about both.
So there was just a piece today, I don't remember if it was the Wall Street Journal or the Washington Post. Amazon led the United States in terms of capital investment. And why would we want to discourage that by taxing revenue as opposed to profits? It seems to be any company that says, rather than pay taxes, we're going to do a lot of R&D and a lot of hiring and a lot of building, seems like it's not a bad thing for the economy, right?
Well, it has two sides of it. I mean, Amazon is very successful and is expanding, but it is a disruptor, and it is killing many other businesses that are paying taxes. So there are two sides of it, you see.
Interesting. So the other pushback I always hear from friends in Europe is, well, our tax rates are higher, but our tax rates pay for our colleges and healthcare and childcare and retirement and unemployment, and you guys are out on your own with that. How do we respond to those sort of challenges? Yeah, we're paying more for taxes in Europe, but we're getting a lot more for our, I was going to say dollar, for our euros.
Well, you know, it depends by country, and in Switzerland it depends where you live. I just tell you that we spend half the amount on our healthcare system than the US, and we get the same high quality service that you get, the same. So obviously there is an efficiency problem somewhere.
So you're arguing in favor of moving from the private sector to a more socialized healthcare?
No, we don't have in Switzerland. We don't have a socialized healthcare. We have a private healthcare. Everybody has to have an insurance, but you are free to choose which one and how you want to define it and design it. You can choose. It's a free market system, but you must have it. It's obviously different in Sweden, where you have very high taxes, in Scandinavia, etc. So it really differs. We have free education. So from the school up to university level, it's virtually free. And we used to have a public school that was better than the private schools. All those who couldn't make it in public school went to private schools, not the other way around. And those were the old days. It is now sort of beginning to shift, which is unpleasant, because our teachers have moved so much to the left that we are brainwashing the kids, that people take them out of public schools and bring them to private schools, not to end up with brainwashed kids to socialism, things like that. So there is a shift going on, but in general, I think the best way to for a nation is to have a free education system that is quality-wise superb for everybody, and is virtually free, because you know, I see so many people deep in debt when they end up their university in the US, that they suffer for many years thereafter. And if they then are not successful in business, or not as successful as they thought they would be, they end up as a problem and they could mess up their whole life.
So Joe, do you have anything to add to that, or should we move on to the question of valuation, which we have not gotten to yet?
Sure, very quickly. I think there are about 8 million people in I was going to say Connecticut, in Switzerland, and you know, we have more diverse problems than they do. As far as healthcare is concerned, about 80% of outcome has to do with how you go into the system. Only 20% has to do with how you're treated. So we're fat and lazy in general, more than in Europe, and that accounts for a big chunk of the reason why we spend more on care. It's not that our care is worse. Of course we could be more efficient, but if you look through the system, it's not like someone's making a whole huge percentage of what we spend. It is an inefficient system, but I was always curious about that in Europe they spend half as much for the same outcomes, and you know, it's troubling. But you know, we do have a health problem here. You know, with the way we eat and the way you know, our lifestyles, and so that's something we have to address as well, and that's 80% of the outcome. So you know, I just wanted to mention that.
Let's shift to valuation. Where are we in the cycle? And let's start with the U.S. We've mentioned stocks are richly valued. Does that mean we're overvalued? And how much more richly can we get? Joel?
Yeah, sure. Well, you know, we're quote unquote value investors, and that doesn't mean we're low price book, low price sales investors the way Morningstar or Russell would classify. We value cash flows, we value businesses, and try to buy them at a discount. And so we have a large value fund. And if you look at the data on that, traditionally, when we've looked over time, we've been able to get a 60%, you know, pick a portfolio of companies that earn a 60% cash flow premium to the S&P for no discernible reason, meaning they're not discernibly doing worse. They're actually doing better, better gross margin trends, better operating margin trends, similar sales growth. A lot of, we've been able to put a portfolio like that earns a lot of cash and still get a 60% premium to the S&P. Today, that's 90%.
Wow.
We can get 90% more cash flow than the S&P for a similar or better business, at least on the metrics that we look at and the trends. So, we're not market timers and saying, oh, we should be 100% in stocks, we should be 0% in stocks. Usually most people, well, if they're pessimistic, maybe they'll be 50 or 60% long. If they're optimistic, maybe they'll be 60 or 70% net long. So you're always looking to put a portion of your portfolio in the stock market. And I'm saying our opportunity set in the more value-related world, both traditionally and the way we look at it, is a historic relative opportunity to the market as a whole. And so So I'm very optimistic. A lot of studies have shown the value, just started, let's say 6 months ago, the value outperformance over growth. Well, it lasted 5 or 6 years after the internet bubble. And, I'm not saying how long this will last. I'm just saying there's a lot more to go. And I can't tell you when it's going to happen or anything. I'm just telling you we're able to buy relative bargains relative to the market as a whole much higher than historically. Even over the last 5 years. So then over any time over the last 5 years. So there's a great disparity right now, great opportunity for value. I think it's going to go for a while. The caveat I gave you before was absolutely stocks aren't cheap. And that means both value and growth stocks and the market as a general, they're not cheap. If interest rates start to go up, obviously you have an issue. I would bring up the fact that, of course, we're going to have a bump in inflation because, we're coming out of COVID and everything else. And the question is, does that last? And if you look back at World War II, the government suppressed interest rates at that time relative to inflation. And, it's not that I'm encouraging the government to, mess with the price of money, interest rates. It should be, where the market sets it. But I do believe the government will suppress interest rates for a period of time. That doesn't mean they won't go up. It doesn't mean inflation won't go up, but you can still suppress interest rates if you're, willing to do unprecedented things like the Fed is working on. And I think they will, because we're running such huge deficits, we can't afford to pay higher, much higher interest rates. So I think there'll be that dichotomy. I don't know how long this inflationary environment will last or whether it's just a one-time blip. I'm not smart enough to know that. I do know, however, that rates can still stay lower than they should be, even if inflation takes off. What kind of mess does that lead to? I can't answer that one either. So it's a world of choices. As an investor, I'm going to be invested in equities as one of my biggest allocations. So I do see the opportunity in value-related stocks, especially the way that we define them. And so for that portion of the portfolio, you're going to be in equities. I'm really bullish on that portion on a relative basis.
Interesting. And Felix, what do you think of valuation, both in the U.S. and globally?
Well, valuation really swings together, globally speaking. They swing together in the cycle, but there are different levels. Valuation has a lot to do with the level of interest rates, of course, and interest rates are at the lowest it has been in our lifetime, and therefore valuation is at a very high level. And compared to its own history, valuation is very high compared to alternative investments like fixed income, bonds or so. Valuation is not excessive for equities. So actually equities are even cheap relative to bonds because bonds are excessively highly valued at the present time. When you look at growth versus value, large cap growth trends in the US, you had really a bear market of growth versus value from 1940 to 2006. So
say that again, a bear market in growth
versus value for 66 years. 66 years. And you had a few counter trend moves in between, like when the Nifty 50s traded in the early 70s. You had in the second half of the 90s, you had a counter trend move in growth stocks. And you have now had a tremendous move in growth since 2009, since the extreme of 2009. And that trend ended last, when was it, September or August, or when it was. And I think when you look at it, it's usually value outperforms when commodities outperform, and when you have a bullish economy, a very high growth economy, when value stocks that are more often than not cyclical stocks have over proportionate advances and increases in their profits. And that's where we are. And the fiscal stimulus provided is really pushing economic growth beyond the natural rate of growth of our economies. That's true that's certainly true for the US, but it will also be true eventually for Europe. And as long as that lasts, I think value stocks and cyclicals will outperform growth stocks. Growth stocks usually do well when interest rates stay low or go lower. And they usually underperform when interest rates go up or bond yields go up, and bonds perform very badly because that's long exposure. That's very long maturity exposure. And therefore, I think as long as the economy runs, and I think we probably have another 2 years or so until the economic cycle turns down seriously, that means that value should outperform growth over that period. Very, very short term, I think we are up for a shakeout, and I see that in the commodity markets, base metals in particular. I think the run in base metals is the big run in base metals is over for the time being. I expect a deep correction, 20-25% or so, in the second half of this year, beginning very soon. And that should impact the deep cyclical stocks like steel stocks, like aluminum stocks, copper mines, etc., etc. So you have some sort of correction, and it could very well be that during that period that bond yields soften a little bit because bond yields hit the high in mid-March of this year, and they have softened since then. Even so, we had a 4.2% print in CPI. You know, they didn't make it back to that high of almost 180, 177 for 10-year governments or so it was. So I think we have a temporary correction in the value segment and value versus growth. The attempt of the growth segments to rally here is not very powerful. They are attempting, they are oversold, they are attempting, they will not go very far because, let's face it, portfolios are still overweighted in those stocks. And therefore, due to the economic scenario that is now consensus, they have to change and they have to be sellers in growth and they have to buy more value stocks. And therefore, I think the value cycle will run a little bit further. My view is that sometimes next year, we will most likely hit the high for the stock market cycle, and followed by a pretty severe bear market cycle, or at least an average, if not above average bear market cycle, because of what I described before. We will have a balance of payment crisis, we will have a dollar crisis, we will have a bond market crisis, and all that will bring stocks down and lead to a recession. And that's my time. That's my timing and my working hypothesis for the timing of this cycle.
So the next 12 to 18 months, markets rally to a peak, roll over, and we see a recession.
I will cut it down to 12, not 18.
Really? Joel,
Yeah.
you're a bottoms up guy. Do you think about long-term predictions like that? Does that work its way into your models, or is it really truly a market of stocks?
Yeah, so, our definition of value, includes companies like Amazon, Google, Apple, Microsoft, Facebook, which justify their prices relative to the market because of their growth prospects, their cash generating, their opportunities, the things that aren't even valued on their balance sheet, that aren't earned money, but are Google's sitting with a whole venture capital firm on its back, that doesn't get counted for anything. So bottom line is that's not where the froth is in the market. I think those are relatively attractive relative to the market in general. So I don't think that's where the problem is. But we did research. There were over 300 companies that currently have a market caps over $1 billion that lost money in 2019. That's pre-COVID.
Right.
Okay, if you bought every one of those companies that lost money in 2019, they averaged a return of 129%. Their median return was something like 73%. Now, those companies so far this year have underperformed the market, but by 2%. So they outperformed by 100%. They've underperformed by 2%. So that's where I see the opportunity set. So, some of our models are not just long. We have Gotham Large Value, which is just long, but we have long short portfolios, and we're short a lot of these companies that are just still levitating. And we haven't begun to collect on those. So I'm not expecting the correction to come, or the relative correction to come in the Amazon, Google's, Apple's, Microsoft, Facebook's, great businesses. Some of the greatest businesses that we've ever seen, well, certainly the greatest businesses I've ever seen in my lifetime, with the best networks and the best franchises. And that's not where I see the froth, to be honest, certainly the relative froth. Where I see it is in these hundreds of names that are just levitating with no earnings, or selling it hundreds of times, that will come to no good eventually. And we have a cornucopia of opportunity in that area that hasn't come home to roost yet. I mean, yes, it's slowed down a little. It's underperformed by a few percent, but it outperformed by 100% last year. So we got a long way to go on those. So I really see a lot of opportunity set as both a long short investor and also as a long value investor. I think we'll have positive returns on the long value, but relatively very, very good returns relative to the market and certainly growth stocks.
Well, I have to say thank you to both of you. We're running out of time. I just wanted to add a personal note. Not only have I interviewed Joel a couple of times and interviewed Felix a couple of times, but over the past decade, having done over 400 Masters in Business interviews for Bloomberg, the very first interview I did in August of 2010 was with Felix. And so I can easily say, if it wasn't for Felix, I never would have had the opportunity to start doing all those interviews with people like Joel and Ray Dalio and Howard Marks and Felix Zulauf. So personally, let me say thank you to Felix for that. Thank you, Joel, for being such a willing participant. And thank you, everybody, for joining us. I found this to be really a fascinating discussion, and I hope everybody else did as well. So
thank you very much, Barry.
My pleasure.
Thank you very much, Barry, and thank you, Joel. Thank you, Joel, for joining.